Okay, so you know that like when you hear those big restaurant chains are saying things are going to be better this year, so, you get that little like flicker of hope. Well, oh, maybe those burgers and fries won't totally drain my bank account.
Yeah.
But should we really be getting our hopes up?
Mm-hmm.
Because in this deep dive, we're going to be tackling a really crucial question. Should you actually buy into all that hype?
You hit the nail on the head. We're diving into this awesome analysis from the Motley Fool, and they're looking at those big names everyone knows, like McDonald's, Chipotle, and they're all putting out these positive predictions. But this article, well, it takes a much more, a more realistic look at what might actually happen. And that's important not just for people who are playing the stock market, but for like anyone who's, watching where their money goes.
Definitely. So we're going to break down this Motley Fool article for you. We're pulling at the most important stuff, the stuff that really helps you understand why these companies are feeling so optimistic, and more importantly, what could actually, trip them up.
Right. What could go wrong?
Right. Yeah. And we're going to do it without all the, Wall Street mumbo jumbo. Just straight talk about what you need to know.
So let's start with the good news. At least from those big chains' perspective, McDonald's and Chipotle, both of them, are saying they think their results will improve as we go through 2025.
So it's like they're seeing some sunshine up ahead, right?
Yeah, they're painting a pretty rosy picture.
And the Motley Fool even mentions McDonald's CFO Ian Borden specifically. He's talking about this gradual stabilization of the economy and like how people are spending their money. So I guess from our perspective, that sounds like maybe things are calming down. Maybe prices won't keep skyrocketing.
That's the message they're putting out there, yeah. And Chipotle's thinking along similar lines. They think the second half of the year will be better, but their reasoning is a little different. They're banking on the fact that it'll be an easier comparison to how they did last year.
Okay, so hold on. Let's break down this whole easier comparisons thing. So basically, if their growth wasn't that great in the last part of last year, even if they just do a little bit better this year, it'll look like a huge improvement, right?
Exactly. It's all relative. They're setting a lower bar for themselves.
It's like grading on a curve.
Haha, exactly. But here's where the Motley Fool comes in and says, hold on a second. Let's not get too carried away with all this optimism. And to understand why they're saying that, we need to look at some numbers, some really important numbers that show how healthy these businesses actually are.
And as anyone who's ever looked at a budget knows, those numbers can tell a very different story than those like feel-good headlines. The Motley Fool article highlights this thing called comparable sales growth. Can you explain why that number is so crucial in figuring out how these restaurants are actually doing?
Absolutely. Comparable sales growth is all about looking at how those existing restaurants in a chain are performing. It basically takes new store openings and closures out of the equation. It's like you're comparing apples to apples.
Okay, so no new flashy locations, just the core of the business.
Exactly. A company could be opening like a million new places, and yeah, their overall sales might look amazing, but comparable sales tell you the real story. Are those older restaurants, those ones that have been around for a while, are they still bringing in customers? Are their sales actually increasing? It's the true measure of whether that business is actually thriving.
Right. So it's not just about the hype of expansion, it's about the health of that foundation. And the Motley Fool points out that the comparable sales figures from the end of 2024, well, they start to make that initial optimism look a little less convincing.
Yeah, that's where the doubt creeps in. The Motley Fool highlights that in those last 3 months of 2024, McDonald's global comparable store sales only went up by 0.4%.
0.4%. That's barely even moving the needle. Like
No.
for a global giant like McDonald's, that almost suggests they're just barely treading water.
Right. And it gets even more interesting, or I guess concerning, if we focus on the U.S. market.
Right here at home.
Exactly. McDonald's comparable store sales in the U.S. actually went down by 1.4%.
So not only are they not growing, they're actually shrinking.
Precisely. Fewer people are spending money at their existing locations in the U.S.
Wow. So while their CFO is talking about stabilization, their performance in their biggest market is actually going the wrong way. That's a pretty big disconnect between what they're saying and what's actually happening. Now, what about Chipotle? They're still considered a growth company, right?
On the surface, they look a bit better, but there are signs that their momentum is slowing down. Their comparable sales growth for that same period was 5.4%.
Okay, that sounds a lot healthier than McDonald's almost zero growth.
It does, but the Motley Fool points out a really important detail. That 5.4% is actually a step back from where they were a year earlier.
Well, so they're not growing as fast as they used to.
Exactly. A year before that, Chipotle had a comparable sales growth of 8.4%. So yeah, they're still increasing sales at their existing restaurants, but the rate of that growth has slowed down quite a bit.
So it's like they're still moving forward, but maybe not at full speed anymore. And the interesting thing for us as consumers is that both of these big companies are predicting things will get better despite these recent trends of, slowing or even negative sales. It makes you wonder, what are they seeing that we're not?
Right. What's their secret sauce?
Exactly. And this is where we need to zoom out and look at the bigger economic picture. It's not just about how many of us are walking into their restaurants. It's about the whole financial climate and how that's affecting how much money we have to spend.
Absolutely. The Motley Fool emphasizes that there's still a lot of economic uncertainty out there. And a lot of people are feeling that uncertainty. Maybe you're being more careful with your spending these days. And restaurants, they can't just keep raising prices forever and expect us to keep paying. There's a limit to how much we're willing to shell out.
Right. At some point, you just got to say enough is enough.
Exactly. And we're actually seeing signs that people are starting to tighten their belts. The Motley Fool article mentions a recent report from Costco, which I found really interesting.
Oh, yeah, Costco. Everyone loves Costco.
Right. They're everywhere. And they've noticed the shift in how people are spending their food dollars. More and more people are choosing to buy food to eat at home. Things like pre-made meals and frozen food.
Makes sense. It's usually cheaper to cook at home.
Exactly. And that's the point. It suggests that people are looking for ways to save money on food, which means they're probably cutting back on those restaurant outings. Have you noticed that in your own spending?
Oh, definitely. I'm way more conscious now of whether I'm eating out or cooking at home. Feels like the cost of eating out, even for something quick, has just gone way up. And going to the grocery store just seems to make my money go further these days.
Yeah, you're not alone.
Yeah.
And the Motley Fool also mentions this potential wild card, the tariffs.
Oh, yeah. Those could make things even tougher for both restaurants and our wallets.
Exactly. The article explains that some tariffs are paused right now, but they could be brought back or new ones could be put in place. And that could create a double whammy. On the one hand, restaurants might have to pay more for their ingredients and supplies, which means they might have to raise prices even more.
Ouch.
Right. And on the other hand, if tariffs affect other goods, well, you and I might have less money overall to spend on things like eating out. So it's a lose-lose situation where both businesses and consumers could feel the squeeze.
Okay, so let's recap. We've got these big restaurant chains putting out these optimistic predictions, but they're facing some pretty strong headwinds. Their sales growth is slowing down, there's a lot of economic uncertainty, and people are changing how they spend their money on food. Plus, there's a whole tariff issue looming. So what does all this mean for investors who are trying to figure out if these restaurant stocks are a good buy? And what does it mean for the rest of us who are just trying to decide where to eat dinner tonight?
Well, for investors, the Motley Fool basically says don't get too excited about those rosy predictions. The economy is unpredictable and things could easily get worse. So they suggest tempering expectations for restaurant stocks in the near future. They even talk about this strategy where investors might look for stocks that are trading at lower prices. It's called a margin of safety.
So if a stock is cheaper to begin with, there's less risk if things don't go as planned.
Exactly. Less to lose. And the Motley Fool says the smartest move for investors right now is to just wait and see what happens. If these companies don't meet their optimistic goals and their sales don't improve, their stock prices could drop.
Which brings us back to you, the listener. How does all this talk about stock prices and investors relate to your everyday life?
Well, think back to that Costco report. Did that resonate with you? Are you finding yourself eating at home more often? Those trends that are making investors nervous, that slowing growth in comparable sales, well, those are often a direct result of how people like you are choosing to spend their money. If fewer people are eating out or if they're spending less when they do, those numbers will reflect that. So your own behavior is actually a key indicator here.
Totally. Like I said, I'm definitely thinking twice before I order takeout or make a reservation. It's hard to ignore those price increases, and when I compare that to what I can make at home, well, it just makes more financial sense to cook more often these days.
And that's the connection. While these big restaurant chains are putting on a brave face and talking about a bright future, the actual data on how their existing restaurants are doing, combined with all that economic uncertainty, well, it paints a much more complicated and potentially difficult picture for them. And that means you might see fewer options when you want to eat out, or those prices might just keep climbing. Their optimistic forecasts might not be taking into account those potential economic bumps in the road or the full impact of tariffs on their costs and your spending power.
So it's not necessarily about giving up your favorite restaurants altogether, but it's about being aware that those cheery predictions might not be telling the whole story. There are these big economic forces at play that could really affect how well these companies do, and ultimately how much you end up spending when you do decide to treat yourself to a meal out.
Absolutely. It's all about being an informed consumer and understanding that the financial health of these companies is directly linked to the overall economy and to the choices that people like you are making every day.
So to sum it all up, while those restaurant chains are crossing their fingers for a comeback and predicting better times ahead, our deep dive into the shoe. The Motley Fool's analysis shows that the reality might be a bit more complicated. The recent data and all those economic question marks, well, they suggest we should take those optimistic forecasts with a grain of salt.
And here's a final thought to chew on. Based on everything we've discussed, how do you think your own spending on dining out might change in the coming months? What specific factors, whether it's the economy or your own personal finances, will have the biggest impact on your decisions about when and where you eat out?
That's all for our deep dive into what's really going on with the restaurant industry. It's a constantly changing situation, so we encourage you to keep these things in mind as you watch your own spending habits and see how the economy unfolds.